Hello, today we'll be discussing Sony, the company that I believe is broadly misunderstood by retail investors because most of the people know Sony for PlayStations, movies, and consumer electronics. But what is often overlooked that Sony actually owns one of the most dominant technology modes in the world in imaging and sensors. It wouldn't be an exaggeration to say that Sony are the eyes behind modern technology. Smartphone leaders like Apple and Xiaomi, industrial giants like Siemens and Fanuc, a large portion of the global automotive industry, and especially robotaxis, they all depend on Sony to function at all. What makes this mode so special is that Sony controls it at every level: manufacturing, chip design, and software. Each of those are hard to replicate. Replicating all three is nearly impossible. Also, in October 2025, Sony completed a rare corporate restructuring by separating its financial arm, allowing management to focus aggressively on higher return segments like sensors, intellectual property, and gaming. Despite all of this, and a recent acceleration of this segment, and all the hype surrounding physical AI and AI industrialization, the Sony stock is not participating in the rally. The stock price is going down for the past months, and it provides a rare buying opportunity of one of the best businesses based in Japan. If you want to learn more, stay tuned. The company's dominance in image sensors is hard to overstate. Today, Sony controls roughly 53% of the global image sensor market, and when it comes to high-end, high-precision products, it's almost entirely dominated by Sony. The smartphone segment is the most mature part of this business and still accounts for around 70-75% of the sensor revenue. And just think about it, every time Apple sells a phone, Sony gets paid. Automotive and industrial sensors, while still a smaller portion of revenue today, are growing significantly faster. If we just compare results for the full year 2024 and the latest quarter, we will see a positive dynamic. For the full year 2024, the revenue grew by 12%, while the operating income grew by 35%. When operating income grows faster than revenue, it means that the operating margin has improved. And from the most recent report, we can see that the revenue growth has accelerated to 15% and operating income has grown by 50%. They also attributed it to an improvement in product mix, which basically means that the segments other than smartphones are growing faster. It is important to understand what Sony actually improved for automotive sensors, because automotive cameras have to work in extreme conditions: bright sun, deep shadows, night driving, rain, fast motion, and high and low temperatures. Sony engineered sensors with a very high dynamic range, LED flicker mitigation for traffic lights and headlights, and ultra-fast readout to reduce motion, distortion, and latency. Sony has pioneered and improved stack sensor architectures, which allow more processing to happen directly on the sensor itself. That lowers system latency, reduces power consumption, and improves reliability. Automotive programs last many years, switching costs are high, and once Sony's sensor is designed into a platform, it tends to stay there. One other thing that I wanted to mention is that Sony and TSMC have a joint venture called Japan Advanced Semiconductor Manufacturing, where Sony holds a minority share. It ensures that Sony has a supply of logical chips for all their needs, and also, as you can see from this article, it attracts players in the field to the region and creates a positive environment for innovation. The other part of the business that is growing strong and has a unique strength to it is intellectual property. Sony have games, movies, TV series, music, and merchandising to make most of their intellectual property. They collect money at every step, and each success funds the new one, reducing the risk and expanding the audience. A perfect example is The Last of Us, It started as a PlayStation exclusive game, a hit on its own, and that success justified a high-budget HBO series. The TV series brought in millions of new fans who had never played the game before. That drove renewed game sales, remasters, PC releases, and future sequels. That's a virtuous cycle that feeds on itself and amplifies success for their intellectual property. Going back to numbers, we can see that the music segment has grown its operating income to 88%, and I've gone through last 8 quarterly reports, and I can say that the year-over-year growth is fluctuating, but it is in double digits, and more importantly, operating income always grows a little bit faster than the revenue, meaning that the margins for this segment are increasingly improving. Picture segment is more volatile and is tied to theatrical releases. So I've seen some quarters when the operating income would go up 63%, but for the past year it's been steadily decreasing. However, part of this segment I'm very bullish about is growing rapidly. It is Crunchyroll. For those of you who don't know, Crunchyroll is a streaming service that focuses on anime, and as you can see from the graph, from 2021, the number of paid subscribers has grown from 5 million to 17 million, almost tripled in that period of time. Also, there was an announcement that starting from January 2026, Crunchyroll ends its free streaming plan. So I expect that there would be a small spike to a number of paid subscriptions. Unlike movies, Crunchyroll provides a steady revenue stream and gives Sony something that very few companies have, an ability to turn local IP into global franchises. Shows that used to be niche now can scale worldwide, almost instantly, with predictable demand and built-in fan bases. And because Sony owns both the platform and most of the content, it captures value at every step. Subscriptions, licensing, merchandise, music, maybe games and movies. Another wise decision by Sony's management is that they don't try to win streaming wars. Instead, they are selling their content to the highest bidder, and even Crunchyroll exists in parallel for anime fans only. That keeps capital light, margins high, and lets Sony profit no matter which platform wins. Now to the gaming segment. This is probably the most popular part of the Sony's business, so I won't take too much time discussing it. Instead, I want to point out a couple of things. As you can see from this chart, only 24% of the revenue comes from hardware. I bring this up because I've read a lot of opinions that as prices for GPUs and memory goes up, the profitability for Sony would suffer. It is true, and it is predictably decreases margins on hardware sales. However, that is only 24% of this segment. Most of the money is done on high margin business as digital software, add-on content, network services. So I believe that Sony has some freedom in their pricing power, so I wouldn't put too much emphasis to this risk. Some is due, of course, but this segment has been growing for decades now. In 2024, they reported 14% growth for the revenue. For the full year 2025, they recently have, and for the year 2025, they have recently upgraded their forecast to 150 billion yen, which makes it a 20% growth year over year. Another important piece of news, in November 2025, Sony has spin-off their financial arm as an independent publicly traded company. Financial services are heavily regulated, capital intensive, very different from Sony's high return business. By detaching that arm, Sony reduced regulatory pressure on themselves, simplified the company, and freed management to allocate capital more aggressively into higher growth, higher margin segments. I expected that this development to be a clear positive for Sony's stock. Instead, over the past months, the share price has fallen roughly 12%. What's interesting is that Sony was already trading at a discount to the sum of its parts, world-class sensors, a dominant gaming platform, and a powerful IP engine. The recent sell-off appears driven more by macro uncertainty around yen and concerns about memory pricing. Over the past 5 years, Sony has gone through an intentional transformation, simplifying the company, focusing on higher return businesses, and strengthening its core moats. I believe that for a long-term investor, this kind of disconnect is a great buying opportunity. But again, do your own research, hopefully get rich, leave a like, subscribe, and Happy New Year. See you next time.